Coming up on a special episode of the Wheelhouse Retirement Show, Rishi welcomes back Marty Ruby to discuss an often overlooked but important component of retirement planning, understanding the tax allocations of your retirement funds and strategies for you to take advantage of favorable tax laws to keep more money in your family and away from Uncle Sam. Plus, Rishi will explain strategies to hit your philanthropic goals. That's later on today's planning tip of the week. The Wheelhouse Retirement Show starts right now.
Retirement is more than a destination. It's a journey that starts with a dream. A vision for the way you want to live, recharge, and give back. To get there, you need a plan to make your retirement dreams come true. Now in its second season, the Wheelhouse Retirement Show provides you with the essential strategies needed to plan your ideal retirement. From income planning and wealth management to strategies for taxes, long-term care, and leaving a legacy, Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group provide modern solutions and comprehensive plans for your journey to and through retirement. This is the Wheelhouse Retirement Show.
Thanks for joining us on today's special episode. I'm Rishi Ghosh, and joining me is Marty Ruby. Marty is an actuary, founder, and chairman of Stonewood Financial, and the author of the No Compromise Retirement Plan, the New Rules of Retirement Saving, and the New Holistic Retirement. Marty, welcome back to the show.
Rishi, thank you for having me.
Glad to have you back in the new studio, and I know you spent decades and decades gaining knowledge about not just retirement planning, but overall in the financial industry. So I know your knowledge is not just valuable for my longtime clients, but also our viewers that have been watching us for years.
Well, I hope so. Hope they learned something.
Can you give us a quick background for our viewers that may not have seen you in previous episodes?
Sure. I'm an actuary by background. We're kind of the numbers geeks of the insurance industry. So we do all the probability statistics studies and so forth. But my background has been product development. For a while, I was CEO of an insurance company that actually led the effort to buy and move to Louisville, which is where I'm from, Louisville, Kentucky.
Yep.
We sold that company, and for the last 20 years or so, I have been for my own company called Stonewood Financial. And the idea behind Stonewood is to use this kind of deep insider knowledge I have of how financial products really work, but rather than using them for the institution, I use them for the consumer.
And that's always what's attracted me to this partnership, because as you know here at Wheelhouse, I believe in total retirement planning, and that's what I've always built my practice and my strategies off of, not just investment strategies, because rates of return are very important in retirement, but coupling investment strategy with true tax planning strategy, and as you know, proactive tax planning strategy, as well as estate planning strategy. And I think, as you and I have had dinner many times in the past, we always talk about how oftentimes investors don't know how much control they could potentially have over their tax strategies.
Right. So it's important to understand that for many people, how they've saved is through tax-deferred plans. An IRA or 401k, where you put money in, get your tax deduction, let the money grow, but when you retire, everything you've put in and all those earnings over the years get taxed. And for many people, they think that's the only way to save money.
You know, tax deferred, and I know I talk about my father a lot on this show. He's a very savvy money manager, but he was always under the belief, like so many of our viewers and retirees, that at some point later in life, they were going to pay a lower tax rate. And unfortunately, a lot of CPAs, TurboTax, H&R Block, nothing wrong with the software. A lot of places want you to dump money into those deferred accounts to save money on tax today. But they often forget about what we call tax diversification in our portfolio. So here we always describe it as 3 different classifications of tax of investment accounts. Can we go through those?
Yeah, so you have your tax deferred, which I just described, and that is how most people think of when they think of retirement savings. You also have tax-free. Now, tax-free, which in my books I write about quite a bit, is a form I like, where your taxes are paid up front, but then everything that goes in the account, and as it grows, it's all tax-free. And finally, you have taxable. You have ones that are just, you're simply taxed every year on what's in your account and what kind of growth you've had in that account.
So let's go step by step and kind of break this down for viewers that have these different classifications of accounts or maybe are looking for more tax diversification. They might have investment diversification already, but looking for more of a strategic tax plan. So let's start with taxable. I know we describe these as maybe people's trust accounts or investment accounts or individual or joint accounts. How exactly are those taxed?
Well, there's two ways those can be taxed. One is capital gains. If the assets in that account tend to be, let's say, into the stock market, you could have capital gains. More likely, as you get older and you become more conservative in how you're running that account, it'll be more like CDs, money market accounts, maybe high-grade corporate bonds, and interest on those instruments are taxed as ordinary income.
So basis is not taxable, but growth and dividends interest may be taxable at whatever rate or capital gains rate is available at the time.
At that time, correct.
I know, Marty, a lot of our clients, similar to my father, who a lot of people know is a very savvy money manager, did unfortunately, in hindsight, the incorrect thing where they dumped a lot of their money into those tax-deferred buckets. Now, there are 3 tax classifications of money for retirees. Can we go through those together?
And this is our main focus of all 3 of my books. Tax-deferred accounts are 401ks and IRAs. As I've said, you put the money in, you get a deduction. So you're reducing your tax that year. As it grows and as you take money out, every dollar you take out is taxable. And the problem is that you don't know today what tax you're repaying on that income in the future. So, Risha, let's say you're about to retire, you're age 65.
Okay.
You may live another 25, 30 years.
Hopefully.
Think about all the changes that could happen in the tax code, the legislative risk, everything could happen that'll subject that tax-deferred account to that tax risk throughout your lifetime.
That's a great point. And I think people have to understand, and retirees and pre-retires need to understand, there are options, there are strategies to potentially not eliminate taxation, but reduce, minimize, and create a strategy for their overall family. As you just heard, there are a few different ways your retirement income is taxed. You probably have money in taxable or tax-deferred accounts. But what about tax-free accounts? We'll talk about that next. Stay tuned.
You've worked hard to build up your retirement savings, but do you know how much you're paying in fees in your investment accounts? Hidden fees can eat away at your hard-earned dollars, and most investors don't know what they're actually paying in fees. I'm Lauren Ferraro, and our team at Wheelhouse Advisory Group can give you a fee analysis so you know exactly where your money is going. Call us to learn how to keep extra costs from eating away at your retirement. Get your complimentary fee analysis today.
Welcome back. I'm Rishi Ghosh, and happy to be here today with my special guest, Marty Ruby. As many of you know, Marty's a financial author and actuary, and he is explaining the different ways our retirement assets are taxed. Now, Marty, before we get back into our different tax classifications, I know in a lot of your books you talk about why taxes are the biggest, least understood form of risk for a lot of retirees. Can we expand on that?
Sure, Rishi. People forget that it's not so much what kind of income can you generate from your retirement account, it's how much do you get to keep.
Okay.
And here's a big problem. When people have saved in tax-deferred accounts like IRAs, they face this unknown. How much will the IRS take of the money they take out of their IRA every year? Tax could change, legislation could change, all kinds of rules could change that could mean they take less, they get to keep less from their IRA than what they originally planned.
And that always makes it difficult for planning when you see a dollar in an account, but not quite sure how much is actually going to land in your account in terms of income purposes, maybe even day-to-day spending or one-off expenses as well. So understanding that is a big key, in my opinion, I know your opinion, in order to have that successful and worry-free retirement. So let's get back into these 3 different tax classifications. I know we went through tax deferred, which is generally the most popular type of account that comes into our office, those IRAs, 401ks, the pensions that some people might take as lump sums, as well as taxable accounts. Often they are trust accounts, joint accounts, where they might have good quality positions that have gains on them. They pay 1099 or long-term or possibly even ordinary income tax on any growth there. But let's talk about our favorite account and our favorite tax classification, which is that tax-free bucket.
Right. And as people could probably imagine, I believe in always looking at the tax code when considering how do I want to save money, where do I want my money to reside, so it's insulated against changes in taxes and legislative risk. So you get to that tax-free bucket. The tax-free bucket mainly says I've already paid taxes on this money, and now I'm going to put it in a bucket where I'll allow it to grow tax-free. So when I take money out, it's tax-free. When I leave it to my heirs, it's tax-free. The Roth IRA or the Roth 401k is probably the most common example, well-known example of this, where yes, you pay taxes up front, but then you're done with the IRS. And from then on, everything accumulates tax-free.
Now, I know, Marty, for a lot of our longtime viewers that have either bought your book or gotten it from our office, you're a big believer in these tax-free accounts, mostly because of your personal situation. So can you tell me and remind our viewers, because I've heard the story many times over, but I think it's just an incredible story in order to help other people understand why taxes and tax planning is so important.
Well, this kind of gets back to when I looked at my own situation about 10 years ago. I realized, like many others, I'd saved tax deferred. And over the years, I accumulated this money, and I got to a point where I said, what did I get myself into? Because I have to pay taxes on all this money. And I asked myself a basic question. If I keep my money where it is today in a tax deferred plan, what taxes will I have to pay for the rest of my life? Not just this year, not just next year, but really for the next 25, 30 years. And it's interesting that I could not find that answer anywhere. So what we've built is a model, a report, if you will, that helps a person understand how much taxes are they likely to pay if they keep their money in a tax deferred account versus if they take some action today, roll that money in what's called a Roth conversion, which is taking existing IRA money, paying the tax on it, and putting it into a tax-free Roth account. What's the difference in taxes? How much do you pay if you don't do anything? How much taxes do you pay if you take some action?
Now, I know a lot of our clients, as well as a lot of our viewers, have seen the software. You call it your retirement tax bill calculator, and it's an incredibly powerful tool for those that are interested in truly proactive tax planning. And I know the beauty of tax planning that we always explain to clients is not only can it potentially save you money today for you and your family, but also for generations to come in terms of inheritance potentially, in terms of maybe even giving money to grandchildren as well. And I know that's very important for your personal situation, having 2 beautiful daughters and 4 grandchildren as well.
Exactly. And one thing I liked about the tax-free is it does not burden the legacy I want to leave my kids and grandkids. It does not burden them with the tax issue. It's gone.
Taking care of not just mom and dad's taxable situation by being proactive, but potentially also alleviating the future taxes for future generations. And I know this is my definition of total holistic retirement planning, making sure investments are in order, taxes are in order, and estate planning is in order as well. Great information. After the break, I'll walk us through charitable planning strategies and options to maximize your family's philanthropic goals. That's next in our planning tip of the week. And later, Marty and I will talk through strategies on how to help you convert your assets to tax-favorable accounts. Stay tuned.
You know it is important to check up on your health, but what about your wealth? If you aren't sure if you've saved enough for retirement, or if you don't know what your taxes will be once you do retire, or if you feel uncertain about how much risk is in your portfolio, then it's probably time for a financial checkup. I'm Rachel Meyer, and our team at Wheelhouse Advisory Group is ready to give your finances a checkup to help you live the retirement of your dreams.
On this advisor tip of the week, we are going to talk about charitable planning strategies to maximize tax savings both for you now and for future generations. When it comes to charitable giving, a lot of people don't understand its true potential. In addition to its philanthropic benefits, charitable giving can also provide benefits to families giving the donation through split interest gifts and other strategies. Donors may be able to benefit from an immediate tax deduction while also maintaining use and enjoyment of the donated asset for a period of time or even an entire lifetime. These strategies create opportunities for those with certain types of assets For instance, landowners have the option of contributing a remainder interest in the property they may have otherwise designated for a charity in a will or trust. This allows them to enjoy immediate tax deduction, which can be used to offset their current income. A qualified conservation contribution or life estate agreement could be used to create these benefits. Those with highly appreciated assets, including closely held businesses, farms, real estate, or publicly traded securities, can use specific planned giving techniques to create diversification in a way that does not result in immediate taxation and has the potential to reduce the overall tax impact. This can be accomplished using a charitable remainder trust, a grantor charitable-led trust, or even appreciated stock depending on the circumstances. Planned giving also offers opportunities for those who are looking to generate cash flow for themselves, for loved ones, or for charities they are supporting. There is even the potential to realize tax savings while doing so. Two techniques for creating income through charitable giving are the use of charitable gift annuities or charitable remainder trusts through a charitable gift annuity. You can also receive a specified income stream for life based on the amount contributed to the charity. Similarly, the charitable remainder trust is a split interest trust that allows you to donate assets to a charity in exchange for installment payments either for your lifetime or a specific period. Both of these techniques allow you to support a cause you care about while ensuring a steady income source for yourself. For those looking to improve the cash flow of a charity, a below-market interest loan can be an effective solution. By paying off the organization's higher interest rate notes and exchanging them for lower interest loans from you, you help the charity while potentially receiving income from the loan. In other cases, a bargain sale transaction might be a suitable option. This involves selling property to a charitable organization at a price below fair market value. The difference between the fair market value and the sale price is considered a charitable donation, allowing you to capture the full property's value while minimizing taxable gain. Last, we have the pooled income fund. This type of trust enables donors to make a tax-deductible gift to a charity while providing income to one or more individuals for life. It's an effective way to support charitable causes while ensuring reliable income stream for yourself or your loved ones. It's crucial to recognize the significant intersection of estate planning and philanthropy. Failing to plan properly can result in significant total tax liability, potentially reaching 40% or even higher. This is particularly relevant for families facing estate taxes and other taxes on inherited IRAs and other assets. To mitigate these taxes, charitable giving becomes a powerful tool. We've already discussed split interest gifts and gifts of highly appreciated assets, but there are other techniques that may be relevant based on individual circumstances and objectives. One such technique is leveraging life insurance to amplify the size of a charitable gift. Another option is designating the donor's retirement plan assets to be left to a charity upon their death. Even individuals primarily motivated by philanthropy will want to take advantage of techniques that accomplish their charitable objectives while also helping address their own financial need. For instance, qualified charitable distributions enable distributions from IRAs up to $100,000 annually to be given to one or more charity organizations. This can address your charitable goals while also satisfying required minimum distributions. And if you desire greater influence over how your charitable gifts are used, there are specific planned giving techniques through which this can be achieved. Whether it's establishing a donor-advised fund or creating a charitable foundation, these vehicles empower you to take an active role in directing your philanthropic endeavors. Understanding the tax benefits of charitable giving is a crucial aspect of optimizing the impact of your philanthropy. The amount of your deduction will be based on several factors, including the type of charity you donate to and the form of your gift. This deductible amount is typically limited to a percentage of your adjusted gross income, or AGI. The specific percentage depends on whether the gift is made to a public or private charity. For cash gifts to public charities, you can deduct the gift amount up to 60% of your AGI annually. In 2026, this limitation will drop to 50% of AGI. For gifts of highly appreciated assets, the limit is 30%. For cash gifts to private charities, the deductible amount is up to 30% of your AGI annually and 20% for gifts of highly appreciated assets. When it comes to non-cash gifts like securities, real estate, or other highly appreciated assets, the value for claiming an income tax deduction should be determined based on either the fair market value or cost basis, whichever is less. Regardless of whether the gift is a public or private charity, if the gift amount exceeds the maximum deductible AGI in the current year, you can carry forward the excess gift amounts for up to 5 years. This provides continued tax benefits in the future. It also should be noted that the actual tax savings achieved is dependent on whether these charitable deductions exceed the standard deduction already available to all tax filers. If total deductions for the year include charitable deductions are below the standard deduction amount, then you can only claim the standard deduction. If the total deductions for the year exceed the standard deduction, then you can itemize to receive the total of those deductions. Another crucial factor in determining the tax impact of charitable gifts is the timing of the gift. Whether it's made during one's lifetime or upon your death, the timing can affect the tax base, the amount of the charitable deduction allowed, and the valuation used for determining those deductions. Understanding these options will help you make an informed decision about your charitable giving, ensuring you optimize both your philanthropic impact and the associated tax benefits. With the impending significant estate tax reduction coming up in 2026, it's important to create a rock-solid estate plan which will allow you to keep more money in your family for generations to come. That's the planning tip of the week. The Wheelhouse Retirement Show continues next. Welcome back, and thanks for joining us today. I'm Rishi Ghosh, and I'm back with my favorite actuary, Marty Ruby. Marty, you're talking to us today about the different tax classifications of people's retirement accounts. And I know the majority of our clients, as well as a lot of your clients, have saved most of their money in tax-deferred buckets. So what are the options for these investors to move money from these tax-deferred buckets into our favorite bucket, that tax-free bucket?
Well, one of the most popular options is called a Roth conversion. A Roth conversion is when you take your existing tax-deferred money, and over a period of time, it did not have to all be in 1 year, but over a period of time, you take money out of that, pay the tax you already owe to the IRS. Get it out of the way now when tax rates are lower, when your account is smaller, so the tax liability is less. Get it into a Roth, and then let it grow tax-free in that Roth. Now, one thing we talk about, because a lot of people say, well, geez, if I take all of my IRA money out at the same time, I'm pushed into higher tax brackets. We tell people a couple answers to that. One is you don't have to do it all at once. It can go out maybe 20% a year or some other plan that you can work out depending on your facts and circumstances.
Right.
And secondly, our retirement tax bill calculator will make you understand that even though I know you don't want to pay tax today on your IRA, you will understand how much cheaper it is in terms of tax dollars to take the action today to get that money start to move over to a Roth, as opposed to just putting your head in the sand and keeping it in your tax-deferred IRA.
You know, it was surprising to me as I've done the show for many years, how many people think that they cannot get money into Roth accounts, especially after they're retired. Oftentimes, while people are in pre-retirement, they know about Roth contributions, whether it's through Roth 401ks, Roth IRAs. But obviously, we're talking about Roth conversions. And Roth conversions can not only be done in pre-retirement, but into retirement as well in order to get that tax diversification. But I know there's a third strategy that has not only worked very well for your individual situation, but you also think it's very popular for people to understand, which is really that IRA to IUL conversion.
Right. So people ask me after I've written these books and everything, well, Marty, I assume you've converted all your money, your IRA money, into a Roth. And I say, well, I've done a lot of it that way, but not all of it. Because when I look at a Roth, it still leaves me with some problems. For example, how do I invest that money to keep it safe? A Roth really doesn't change that issue at all. But more importantly, does a Roth provide any additional benefits for long-term care? Well, no, it doesn't. Does it provide any additional money for a legacy? Because I don't know about your viewers, but as I get older, I realize I'd like to leave something behind for my kids and my grandkids. And really a Roth, like an IRA, is what I call a zero-sum game. Every dollar you spend is one less dollar you can leave behind. So I went back to the tax code and I said, how can I further diversify, keeping it tax-free, but create these other advantages as well? And so I looked at a section of the code, which nobody will know about, I'm sure, looking at this, but called 7702. It's about life insurance. And I tell people, don't get upset with these two words, life insurance. I'm not talking about any kind of life insurance out there that your viewers might be familiar with, but something called Index Universal Life. It is a type of product that under 7702 is tax-free, just like a Roth. But unlike a Roth, it is designed to generate income tax-free while you're living. But when you die, it provides an additional death benefit tax-free to your heirs. Rishi, life insurance is the only asset that is worth more the day you die than the day before.
Yeah.
Finally, it also provides additional benefits for long-term care. So what I did is I kind of further diversified my portfolio. I wanted to keep it all tax-free, but the Roth didn't do 100% of my needs, and I further diversified into Index Universal Life as a way to pick up things I can't pick up elsewhere. May not be for everybody, but it's an option I think that people at least should look at.
And I know you just prefaced it right there that obviously there's not one size fits all type of investment for anyone. So how do you generally guide people on deciding, does a Roth IRA make sense for me? Does Index Universal Life make sense for me? Does a combination of them both make sense to me? What do you generally guide people, and how do you guide people to make that decision?
Well, first of all, they have to look at their needs. Mm-hmm. What are their biggest, if long-term care is a big need, if legacy is a big need, then certainly that would indicate some portion of their assets should be in Index Universal Life. Mm-hmm. But I also say, look at some of the numbers. Look at some of the numbers and run them out and say, is a Roth going to provide more value, or is Index Life, or some kind of combination of the two? Look, they're both diversification. The one thing I've learned as an actuary is that you never want to put all your eggs in one basket because things could change. So I view it as some of both is going to well diversify you in terms of taxes, in terms of income, in terms of legislative risk. All these things combined, a Roth does certain things, IUL does another. And again, I can't explain for every particular need because I don't know the individual need, but I know for where I stood in my needs, that diversification made a lot of sense.
It's great, and it's unbelievably important information, especially if proactive tax planning strategies are important to make sure you have a worry-free retirement. So thank you so much, Marty.
Great.